This swing trading strategy made me 180% this week. We're gonna structure this video into 4 parts: the thought process, the planning, the technical analysis, and the execution. Before heading into that, there are few rules. Always stick with the stocks which has a dominant uptrend. A strategy is not to buy low and sell high, it's buy high and sell higher. Drown all the noises, focus on the price. At the end of the day, price is the only thing that pays. With that being said, let's start with the thought process. The ticker we are going to take a look at this week is MNST, the Monster Energy Drink. Leading into this week, the MNST charts was looking like this. We're looking at the daily charts here. I see a huge consolidation for the past 6 months between 2 price zones and a breakout. Now, the price was consolidating above the breakout area, finding buyers. The bias here is for continuation to the upside longer they stay above this breakout area. Now, this thought process alone isn't going to make me money. I can have multiple buyers on the same chart, but that's not going to help me in any way whatsoever. What is going to help me though is how I go about analyzing, planning, and executing the same setup which I see. This takes us into the analysis section. I see 2 things here: a 6 months of consolidation between 49.24 to 52.30. They finally broke out of the 6 months consolidation range on 31st of March. They pushed all the way towards 54.46 before coming back to run a test towards the top of this consolidation range. You can call it basing. They tried to crack under it multiple times. Buyers immediately got it back above. Those wicks from these candles which you see tells you a story. They made a low of 51.80, which will be the swing lows of this chart. Oh, it's a bear flag! Bear flag! That's how you sound like. The thing about flags, the bearish patterns tend to fail when the broader trend is bullish. The bullish patterns tend to fail most of the time when the broader trend is bearish. From this daily chart, we can see the pivots, 52.30. Longer they steer clear of this area again, it opens doors for continuation towards new highs. This is where the anchored VWAP steps in. I anchored the VWAP to all-time highs, which is at 54.46, and I anchored the VWAP to the swing lows, which is at 51.80. Notice how the price is reacting towards these all-time highs AVWAPs and finding sellers. I don't want to get involved anywhere in here and play a guessing game. Remember, we buy the strength from the pivots and not the pivots itself. We do this to keep an eye out for the money flow. The AVWAP tells us if the average buyers who purchase the stock from these zones are making or losing money. Positively sloping AVWAP means the average buyers are making money. Negatively sloping means the average sellers are making money on the same setup. Why these 2 areas in particular? Because price gave a decent reaction to the opposite direction from these areas. Markets told us that these areas are important. Now, once you anchored the VWAPs, you can note something here. Last week's Friday, they comfortably closed above both of them, and both of these AVWAPs starting to slope positively, which is a check mark. Now we got our pivots, which is at 52.30. We got our confirmation for strength with the AVWAP from the underlying trend. Now, let's move on to the smaller time frame and attach the 5-day moving average. In 15-minute charts, the 5-day moving average is 130 MA. Why 130 MA? There are 1,950 trading minutes every single week. You want to give equal weight to every candle for that week. So you divide the 1950 divided by 15, you get 130. That's your 5-day moving average in 15-minute charts. Last Friday, they tested the 5-day moving average and gave a nice bounce to the upside and closed above it. It's the slope of the 5-day moving average that we care the most about. The slope here is positive, which tells us the momentum is favoring the bulls. Here, the technical backs our bias. If you notice something, our charts doesn't have like 100 supports or 100 resistance lines in them. Always remember, Those are your supports and your resistance lines, not the markets. Markets doesn't care about your levels, it's gonna do what it always does. The more lines you have in your chart, you're gonna be paying more attention to your levels instead of paying attention to what the market is actually telling you. With the AVWAP on this 5-day moving average, we are mainly focusing on the momentum and the money flow. If you notice something, we are only using those pivots as an area to manage the risk rather than an area to buy or sell. We don't know if a particular level is a support or a particular level is a resistance until after the fact it happens. If you are buying blindly into these areas, you're taking huge amounts of risk by doing guesswork. Which brings us back to our rules. Don't buy the dip, buy the strength after the dip. As traders, we gotta play the devil's advocate and look into the factors that can potentially derail this trade. We have earnings on May 4th. This initial plan was to get rid of this position, winning or losing, by the time. Now, we have the bias and we have the technical analysis where the price is backing that bull bias as well. But this is still not enough to make me money. If you give the same chart to a 5-year-old, he's gonna tell you what a double top or head and shoulders or double bottom is. What are you gonna do with the same chart matters more than you figuring out the patterns or you figuring out the technical analysis on the same. This brings us to the planning and execution stages. This is where we come up with a good risk to reward trade from the same setup. This begs the question, what is risk to reward? What is a proper risk to reward trade? Let's say you buy a call option and you set your stop losses at $60, which means if the contract drops under $60, you're gonna sell it for a small loss. Here, the stop losses is the risk. In this example, the $60 is the risk. We call this risk R. I'm a big advocate of 3 R's. By 3 R, I mean if you're setting your stop losses at $60, you should at least make $180 from the same trade, which is 3 times your stop losses. If you believe that the trade is not going to move 3 R's, then it's not worth taking the trade in the first place. From this chart, 53.07 is the current stock price. We spoke about how 52.30 is a potential important area of interest. Setting the stops at the exact support level is how you get stopped out only to see the stock price push higher. We don't like to do that. Always a few cents under. We know that 52.30 is an important area. You set your stop losses at 52.07. By doing this, your entry is at $53, your stop losses is at $52, your overall risk is $1, which is the initial R. With this, you should be planning on making at least $3 to the upside for capturing 3 R's. Let's take 100 trades for this sample. And let's say you'll win only on 30 trades, but you lose on 70. But every time you lose, let's say you keep your stop losses on all these 70 trades at $30. But every time you win, you're winning 3 R's. You're making at least $90 for those 30 trades which you won. Do the math. For the 70 trades what you lost, you're losing $2,100 as a whole. But for the 30 trades which you won, you're making $2,700, still returning almost $600 in profit. At the end of the day, the win rate doesn't matter. It's the risk management does. Every time I say manage the risk, this is what I mean. Focus on 3 R's. If you're trading with options and picking a call with a delta of 0.60, the delta of the same becomes the risk, which here will be $60. So the R equals 60. R refers to the risk as mentioned before. Notice how I'm not setting the stops based on the percentage of the options but on price of the stock. It gives me more control over market's important levels than my own. Now, you know exactly how much you'll be losing if this trade goes against you. Knowing this plays a major role psychologically as it takes away the stress of what if it keeps going lower. Well, that doesn't concern you anymore as you'll be out if this trade which you're holding is down $60 a contract. By 3R, every time you pick a trade you got to aim for at least 3 times your risk and profits as mentioned before. Here, it's at least $180, which will be at least $2.5 move to the upside multiplied with the delta of the current option. Now we got a plan. Entry is at $53, stop losses is at 52.07, potential profit taking will be at $55.50 to $56 to the upside. Now everything is starting to come together. All left is the position sizing. How much contracts you buy or how much shares you buy on the same trade matters more. Always get into a habit of buying multiple contracts within your risk levels, of course. By doing this, you can sell half once the stock moves in your favor until your risk level. For example, if you set your stop losses at $1 in a stock, and if a stock moves up $1, you can sell a few contracts to cover the initial risk and move the stop losses on the runners to break even. By doing this, even if the stock reverses from this point, you will still be kicked out for a small profit instead of taking a loss on the entire position. The runners will be cut once the 3R is reached, which we discussed earlier. How you manage the winners matters as equally as how you cut the losers. We opened the MNST trade at $53. We cut one of the contracts once the initial risk has been covered at $54.50 and closed the entire trade at $55.70. If you are a beginner trader watching this, notice how calm and planned this entire trade is. There is no panic as we had a solid plan. There is no second guessing as we exactly know how much we will lose if the trade goes against us, and we know exactly where to take profits if it goes in our favor. So, with markets, only thing that you can control is your risk levels and the way you plan and execute. You don't have control over what the stock price will do. You can't control the unknown. So stop focusing or looking for a strategy that yields you higher win rate. Any strategy without a proper risk management fails. Successful and professional traders have a win rate averaging of 28 to 30%, but they still end up being profitable not because they keep winning, but because they follow the rules of 3Rs and have a system where the winners always outweigh the losers. Go ahead and check out the Patreon if you want to be updated on the trades like this in real time. We took the similar setup with McDonald's, we took the similar setup with DraftKings. But one thing to note, it's not always winners. We do have some losers as well. We shorted Nvidia on the weakness, we got stopped out as the stock went higher. We went long on Google 2 weeks back, we got stopped out because the stock went lower. Comes to show, it's not about being right versus being wrong, it's about having a proper plan and a proper risk management and a proper system which is going to make you profitable. As always, take high probability trades, manage the risk wisely, have a plan, and I'll see you guys in the next video.